Hello and welcome to this new section on financial analysis and valuation and the first lecture of that in this course, Finance and Accounting Fundamentals. So in this section, we will give you an in-depth view, some in-depth view of financial analysis and valuation. And in this particularly, we'll talk about the financial ratios like liquidity, profitability and solvency ratios. So, what are these ratios and how can you use them to do financial analysis and valuation? Any thought? Let's take a look at them. So, first let's look at the liquidity ratios. Liquidity ratios are financial metrics that those are used to determine a company's ability to meet its short-term obligations using its most liquid assets. So, important thing, using most liquid assets, how can you meet the short-term obligations? Now, what are the common ratios? They are current ratio and quick ratio. Let's take a look at the current ratio. So, current ratio is calculated as total current assets divided by the current liabilities, and we saw that what are the current assets and liabilities. And here, this ratio measures the company's ability to cover its short-term liabilities due within 1 year with the short-term assets like cash, receivables, inventory, etc. Now, here a ratio of 1 or higher is generally considered healthy because it indicates that a company has enough assets to cover its liabilities. Let's take a look at example. If a company has $200,000 in current assets and 100,000 is current liability, its current ratio will be 2 equal to 200,000 divided by 100,000. This basically means that the company has 2 times the amount of assets to cover its short-term liabilities, the current liabilities. Then the second ratio is the quick ratio or acid test ratio, and the formula of that is quick ratio equals to current assets minus inventory divided by current liability. And this ratio is a stricter measure of the liquidity compared to current ratio because it excludes inventory from the current assets. Because inventory can sometimes take longer to convert to cash, so this ratio, right? So these are some of these liquidity ratios. Then let's look at profitability ratios. Now, profitability ratios are those matrices financially that are used to assess the company's ability to generate profit relative to its revenue, assets, or shareholder equity. So, profit not in absolute term, that is called profit, a profitability meaning either relative to revenue, assets, or shareholders' equity. The most common profitability ratios are net profit margin and return on equity. Now let's take a look at net profit margin, which is net profit margin equal to net income divided by revenue into 100. That's a percentage of revenue you are expressing net income. And this measures how much of your revenue as a company is converted into actual profit after all expenses, including taxes, interest, and operating costs are deducted. Obviously, a higher net profit margin indicates more efficient cost management and profitability. Let's take a look at an example. If company has a net income of $50,000 and a revenue of 500,000, its net margin will be 10%. 10% equal to 50 divided by 500,000 into 100. And this means the company makes 10 cents in profit for every dollar of revenue. The next one we will look at is the return on equity, ROE, and there the formula is return on equity equals to net income divided by shareholders equity into 100%, shareholders equity. And this measures how effectively is a company using its shareholders equity to generate profit. It shows the return the investors are getting on their invested capital. Obviously, a higher ROE is typically seen as a sign of effective management and strong financial performance. Again, let's take a look at an example. If the company has a net income of 100,000 and shareholders' equity is 500,000, its ROE is 20% equal to 100,000 divided by 500,000. Now, this means that company is generating a 20% return on money invested by the shareholders, right? Let's look at last set of ratios as solvency ratio, that are again financial metrics that says the company's ability to meet its long-term debt, right? So we are talking about long-term obligation. Two common solvency ratios are debt to equity ratio and interest coverage ratio. What is debt to equity ratio? Debt to equity ratio is equal to total liabilities, total debt divided by the shareholders' equity. And here, when we're talking of the liabilities, we are talking of long-term liability, not short-term. Now, this ratio measures the proportion of company's total liability to shareholders' equity, especially the long term. It shows the extent to which company is financing its operation through debt versus equity. A higher ratio indicates higher financial leverage, meaning the company relies more on debt. Now, this can be risky if the company struggles to service its debt, and normally a debt to equity ratio of 2 is considered adequate. More than 2, you are getting into riskier ground. Now, if example, let's take a look at, if a company has 1 billion debt in its liabilities and 500,000 in shareholders equity, its debt to equity ratio will be 2, equal to 1 billion divided by 500,000. This means company has twice as much debt as equity, suggesting significant leverage. Then there is interest coverage ratio. The formula for that is earnings before interest and taxes, EBIT, divided by the interest expenses. This measures the company's ability to meet its interest obligation on debt. It shows how many times a company can cover its interest expenses with its earning. A higher ratio indicates that the company is more capable of handling its interest expenses, while a low ratio signals potential financial strain. Example, if a company has 500,000 EBIT and 100,000 interest expense, the interest coverage ratio is 5, equal to 500,000 divided by 100,000, and this means company can cover its interest expenses 5 times over, which indicates a strong ability to meet its debt obligations. So having had looked at these financial ratios, what do we do next? We will look at a valuation method called discounted cash flow, DCF analysis, where we will talk about how can you value an investment based on its expected future cash flows. So thank you so much for watching this first lecture of financial analysis and valuation in this course, Finance and Accounting Fundamentals. I hope you're continuing to learn new things, continuing to enjoy, and I do look forward to see you again in the next lecture. Please feel free to message me if you have any questions. I'll be happy to answer your questions. And do download the PDF file to take a look at all those ratios and examples.